An S corporation is a powerful tool to shield your income from self-employment taxes, but its legal protection is delicate. The IRS holds the authority to revoke this corporate status entirely, and they can do it retroactively. When that happens, the legal structure is forcefully collapsed. Your business reverts back to a sole proprietorship, or a partnership if there are multiple owners. Suddenly, you are liable for the self-employment taxes you thought you avoided, plus years of penalties and compounding interest. This catastrophic collapse is rarely caused by outright fraud. It is almost entirely triggered by a single mathematical accounting failure. It happens when you drive a metric known as your inside basis into the negative. The trap is behavioral. Owners look at a healthy bank account and use that available liquid cash to dictate their shareholder distributions. The illusion of safety provided by a high cash balance masks the underlying vulnerability and ultimately triggers a destructive IRS audit. Corporate accounting relies on a strict equation. A company's assets must equal its liabilities plus its equity. This equity section represents your inside basis. This is the retained equity and the built-up goodwill you have accumulated within the company over time. Most S Corp owners pay themselves a standard W-2 salary. Because this is an ordinary business expense, it pulls from cash but leaves that core inside basis intact. But owners often compensate themselves further by taking shareholder distributions out of the business. These distributions are not drawn from general revenue. They are drawn directly against your inside basis. Every dollar you distribute physically lowers that available pool of equity. If you keep pulling, that built-up goodwill drains until the balance hits zero. An S corporation's legal legitimacy is not determined by its gross revenue. It is mathematically bound to maintaining a positive equity balance. Operators often assume that if the business has cash in the bank, it represents safe, distributable equity. Let's test that. When $100,000 is deposited into the business, both the bank balance and the inside basis rise equally. Now we factor in depreciated assets. The cash in the bank hasn't moved, but the depreciated value caused a direct drop in basis. Next, we add liabilities. When debt is recorded, it drags the equity down significantly, leaving the bank balance entirely untouched. We now have a critical divergence. The company has high liquidity, but it is structurally hollow. Business owners feel secure because they only monitor the cash ledger. They see the money and assume it's theirs to take. This is the cash trap. When the operator draws a large cash distribution based on that bank balance, the inside basis plunges below zero. The company's accumulated equity and goodwill are now mathematically negated. The bank account measures liquid survival. The inside basis measures structural solvency. Confusing the two inadvertently destroys the corporate structure. When the IRS audits the business and detects this negative basis threshold, the rules change. The agency's logic is strict. Operating with negative equity implies the entity is no longer functioning as a valid corporation. This allows the IRS to pierce the corporate veil. They initiate a reclassification process, and the S Corp status is dissolved. This collapse immediately invalidates prior tax returns, generating retroactive liabilities for self-employment taxes you never paid. Then comes the compounding punishment. Fines and interest are stacked onto the original tax debt. The danger compounds over time, because auditors can look back multiple years, assessing fines across your entire operating history. Drawing excessive distributions doesn't incur a simple fee. It rewrites the entity's history, stripping away years of assumed tax protection. To protect the S Corp status, operators must change how they evaluate corporate health. Owner distribution decisions must be completely decoupled from liquid bank balances. The active defense mechanism is a precise, continuous tracking of your liabilities and depreciated assets against your retained equity. Maintaining this strict balance sheet awareness prevents the company from going upside down under the weight of its own distributions. This requires rigorous, ongoing bookkeeping protocols to maintain the mathematical defense. When you ensure structural solvency, you remove the fear of an audit, freeing you to focus entirely on growth. Maintaining an S Corp requires continuous mathematical discipline to safeguard your wealth. To learn how to protect your